again, and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our May 4th of 2023 edition of Market Insights and Observations. Let's go to the three topics that are moving markets and we're paying attention to. We're positioning accordingly, and as you should be too. So thanks for watching. Let's get right to it. So right out of the gate, we have the Federal Reserve yesterday, Jerome Powell ending the two-day meeting. And the question is, has the Federal Reserve paused after their most recent rate hike? We're going to discuss that. As well as the regional banks are still under pressure, specifically here in California, and that's having a big impact on the market, as well as a historical look at bulls versus bears in a market perspective. When we have market volatility, it's always good to take a look at that. But let's go right to the Federal Reserve raised. Here the readout, and we watched the press conference, and ultimately, it's not what the Federal Reserve does, or even the minutes per se, but it's almost the body language and what he says, the Federal Reserve Chairman, and what he actually doesn't say, to some cases in the Q&A portion of it. But they raised by 25 basis points. They've taken the Fed funds target to up 25 basis points to 5%, to 5.25% right now. And if you recall, just about 14 months, we've seen over 500 basis points from a zero, more accommodative dovish policy all the way up to very restrictive, and ultimately hopes to slow down the economy and to actually tackle inflation is the ultimate goal. The statement acknowledged that that the tighter credit conditions are a result of the recent banking system, and that there's an economic activity in hiring and inflation and real impacts to the economy. So at least they acknowledged. In fact, that was the first question right out of the gate, which was with regards to First Republic, the most recent bank that was taken over by J.P. Morgan about a week ago. The Federal Reserve Chairman highlighted that the cumulative impacts of the tightening, like I said, over the course of 14 months, 500 basis points, have a lag effect. We've talked about this before in terms of our updates. So it takes time for interest rates to grind the economy slower and ultimately slowing down and tempering the inflation back down to its 2% target level. Right now, we're about a 4% on the inflation read. So we got about 2% more to go if you actually want to follow the math and the calculus on that. And as a result of the current inflation regime, the Fed has attempted two potential forward paths. And this is interesting. One could be the pause and hold at the current restrictive level. But Jerome Powell also laid out a scenario where there's a potential to continue. So second potential to continue the rate hike campaign up at one of their upcoming meetings as they continue if needed. Now, what are they looking for? We're going to discuss that. And they also said that the balance sheet reduction and the quantitative tightening strategy remains unchanged. But some of the highlights here, let's see if I can get this for you. Some of the highlights here where he says that he still thinks the policy is tight, but if you put the credit tightening on the top of the current level, quantitative tightening, they're not going to be far off from where they are right now. So that kind of indicated that they are actively monitoring what's happening, especially in the small regional banks as their pressure persists. However, there's no decision to pause has been made as they push back against inflation. And ultimately, he flat out said several times, it's the inflation, it's the wages, it's inflation. And then he kind of pivoted and said, well, it's not just the wages, it's also the demand side that we're seeing. So the economy is still robust and healthy. Now, if we were to look at the employment picture as the Federal Reserve does, now this is basically the Conference Board employment indicator also pointing towards lower payrolls. The Fed, is looking for non-farm payrolls and ultimately sort of slack in the tight labor market. So as I said before, if you watched earlier this week, I was talking about the JOLTS report, which is a positive report in the view of the Fed's eyes, which is there used to be 2 job openings for every one person actively looking. Now that ratio is down to 1.6 for every one. This also indicates that the non-farm payrolls are moving down in the correct direction, both by the labor indicators as well as the non-farm payrolls. So that is a positive. At least it could potentially set up a pause where we are at the interest rates and hold it. Now, the Kansas City labor market index also showing signs of weakness and ticking up in terms of the labor market and unemployment as well. So the blue line follows the red line, and the Kansas City labor market red line is actually ticking up. So that means that we could see in the next few months the labor market, as reported in the unemployment rate, ticking up from where it's historically at a pretty low level right now. Let's look at the bulls and the bear market. Now, what you're seeing, I don't expect you to see it at home, but from afar, I'll just sort of go through this. January is a historical look. If you were to stack up all of the bears versus all of the bulls and how long those markets are relative to each other, meaning the economy or the markets are contracting versus the expansion. On this chart, the yellow, going back to January of 1926, indicates all of the expansionary periods of time of the markets, as represented by the S&P 500, all the way through December of 2022. And as you can see, the yellow far outweighs the blue. The blues down here are the bear markets, and that's 1929 way on the bottom, and this is the 1970s, early 2000s, and this is where we are today. So historically speaking, if we look at the downside, there have been larger and more sort of damaging bear markets that we've seen, historically speaking, if we go through the cycles. But as you see, the average gain in a bull market is up 303%. The average length of a bull market, it is 69 months. So it's 300, let's do this right here. It's 300%. That's the average upside of a bull market. And we have about 69 months. That's the length of a bull market. Now, what about a bear? The average length of a bear market is 14 months. And the downside is 35% on average. Now, clearly, we've seen further and greater downsides, early 2000s, the 70s at some cases, and then obviously going back to the late 20s, early 30s during the Great Depression. But this dichotomy of, listen, you have to position accordingly in bear markets. Again, we've pulled in treasuries, we've added cash and deployed that into short-term treasuries, and we're waiting. And we own high quality companies that we don't trade, we own. Because if we were to trade them right now, we've got long-term capital gains, and we have to be right twice, the timing of selling and the timing of buying. So we own quality. We own quality on the fixed income and the equity side, and we've added more fixed income on the short-term treasury. So we're in the short end, high quality of the yield curve, and we're ready to redeploy that once we see sort of a washout or a flush out. And that could happen with the timing at the same time. If we see a higher volatility, a big washout in the market, and then the market flips from a bear market, which we're in currently, to a bull market. And long term, if you have a long perspective and a long view, historically, you've been very well rewarded for just that patience. And then also taking advantage of when the market is down. And that's what we're doing on our strategic rebalancing. Our diversified and balanced approach can weather markets. But we're on it, we're paying attention, and we're being proactive. So if you have any questions or want to review your portfolio, review your financial plan, we're here for you at Blanke, Schein Wealth Management. And we hope all is well. You take care, and happy 4th, and then happy Cinco de Mayo tomorrow. Thanks for watching. Take care.